Now, we might ask the question, why would the government introduce a contractionary fiscal policy stance over the short to medium term? There are really two major candidates of explanations for why the government would pursue a contractionary fiscal policy stance over time. One of them is this: if the economy grows too fast, then the unemployment rate might fall too low. What's too low here mean? Well, below the non-accelerating rate of unemployment. What's that estimated to be? Well, between 4 and 4.5%. Now, if that were to occur, wages would start to rise too fast, and these wage increases would be passed on as increased costs to businesses and then to price inflation in the economy. And price inflation that might be beyond the acceptable range given by the RBA of 2 to 3% inflation. So that's one possible explanation: inflation fears. However, there's not really much support for that. The Reserve Bank itself doesn't seem to be particularly fearful about runaway inflation. From the Reserve Bank of Australia board minutes from the 4th of May this year, it stated, "A pickup in inflation and wages growth was expected, but this was likely to be only gradual and modest, despite the lift in the forecast of output growth. It would take some time for spare capacity to be reduced and the labour market to be tight enough to generate wage increases consistent with achieving the inflation target. Moreover, it was likely that wages growth would need to be substantially above 3%, which was well above the current level." Indeed, if we look at the unemployment rate and the annual wage increase rate, we can see that although the unemployment rate has clearly fallen, there hasn't been any sharp change in the annual wage rate growth. You can see it's well below what the Reserve Bank would be concerned about of 3%, it's half of that. And indeed, we should probably look beyond the unemployment rate, because this can be a misleading indicator of excess capacity in the economy or slack in the labour market. We need to really look at the underutilisation rate. And when we do that, we can see that there is clearly a good degree of excess capacity in the economy, so that demand or total expenditure could grow considerably without having any substantial impact on the annual wage rate growth. So it seems like the fear of inflation explanation for contractionary fiscal policy is a poor one. Perhaps we need to look at a different candidate. A second candidate that would seek to explain this contractionary fiscal policy stance would go something like this. It's hoped that after the pandemic is over or close to over, that private spending will take up the slack. So even though the government is engaged in contractionary fiscal policy, the private sector of the economy will come roaring back. There'll be an increase in economic growth, an increase in domestic income, thereby enabling the government to reduce its expenditure growth and to increase its revenue growth, such that its budget deficit will start to naturally decrease, inverted commas, naturally decrease over time, which means the government will need to borrow less if it has smaller and smaller budget deficits, and the growth of the net public debt will get smaller and smaller. So this seems like a plausible kind of claim. If we look to the budget projections, we can see that the government's projecting net export growth to actually be negative over the next few years. However, total business investment is expected to grow, according to the government. And household consumption expenditure is expected to grow. So this is what the government is imagining might occur. These projections, however, are perhaps a little bit optimistic. In the case of consumption spending, the projected average growth is almost, well, more than double the previous 5-year average growth in consumption spending. Perhaps real consumption growth can be indicated by sustained real wage growth. But if we look at the government's own projections of real wage growth, we can see that it's virtually zero. So if consumption spending is not going to be fueled by real wage growth, then what could it be fueled by? Well, one possibility is by decreased savings and increased borrowing. If we look at the most recent data that we have on household consumption and the savings ratio, we can clearly see that household consumption expenditure has spiked up recently, and correspondingly, the savings ratio has dipped down considerably. And we might expect that household debt will go back to its increasing trajectory over time. What about investment expenditure? The government is projecting that to grow substantially. Well, investment spending is notoriously volatile and it's difficult to predict. It's highly dependent on investor sentiment, that is, subjective optimism or pessimism about an unknown future. So your investors are always having to think about not just what the circumstances they face now are, but trying to imagine what the future will be like. What will interest rates be like in the future? What will global economic growth be like in the future? What will consumer sentiment be like in the future? What government policy changes might be around the corner? And what COVID policies might have to be introduced or rolled back in the near future as well? These are all very uncertain at the present time. And we can see that since 2020, 2021, the private investment as a percentage of GDP has been below its pre-COVID levels. And if we go and look at investor confidence indexes, we can see they wobble all over the place. So it's very hard to say exactly what the future holds for investment growth. This, to some extent, undermines the government's own projections about the future. So we have to remain somewhat skeptical about future projections. Nonetheless, the government does seem to be intent on, if it's not actually going to achieve smaller and smaller budget deficit, it certainly is the intent to achieve smaller budget deficits over time. And the explanation that we gave, this second explanation, was really to reduce government borrowing so that it's contributing less and less to total public debt. As we can see here, the government's projections of net public debt, not gross public debt, net public debt is increasing over time. For 2021-22, it's $729 billion. And in the next few years, it's projected to be getting close to touching $1 trillion. Well, that sounds like an insane amount of money. But really, we need to think about the public debt relative to the size of GDP to get some perspective on it. So for 2021-22, net public debt is 34.2% of GDP. And once it gets close to $1 trillion, it'll be around about 41% of GDP, projected anyway. These are not particularly interesting numbers, so to speak. They're not something to write home about as an emergency. By international standards, these are very modest percentages. One might ask whether the net public debt is really a problem at all. One way to think of it is to ask the question, is the net public debt sustainable? Is it affordable? Well, if we look at the coupon interest rates of Treasury bonds are the means by which the government makes up the shortfall in its budget. It issues Treasury bonds, basically IOUs. It issues Treasury bonds and uses that to fill the hole in the budget, so to speak. Now, the coupon interest rates on the Treasury bonds are currently extremely low. This means that it's very inexpensive for the government to fund its budget deficits, despite the fact that they're extremely large in historical terms. The net interest payments that need to be made on the net public debt are, as we can see here, for 2021-22, $4.7 billion. I'd say, well, that's a lot of money, $4.7 billion to be spent for the year on interest payments. Well, not really. We should think about those net interest payments not in absolute terms, but relative, for example, to GDP, relative to the size of the economy. And when we do that, we can see that the interest payments to be made on the net public debt are extremely low. It's 0.7% of total GDP. You might say, well, yes, that's for the economy as a whole, but what about interest payments to be made relative to the size of the government's revenue from its budget? Well, even in that case, it's extremely low. It's hovering at around about 3% of total government revenue would be devoted to interest payments. This is an entirely sustainable debt servicing arrangement, and there's really nothing to write home about. So it would seem that there's not really a great economic explanation for why the government is so concerned about following a fiscal policy stance that's contractionary, that is reducing its budget deficit down to zero, ultimately to get to surplus. If that's the case, then perhaps in order to explain this stance, we'd need to look beyond the realm of kind of a technocratic approach to economics to a more political approach. That is, we need to look to political motives and perhaps ideological motives, a certain worldview about how the economy should function and what role government should play in it.